Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
And here in the next chart, you can see the foreign claims as a percentage of GDP for Eastern European countries. This is a very big problem, but you have to watch out in the future. I think the period from now until the end of the summer, let's move to the next slide. Okay. The period from now until the end of summer, it is very important. Greece will have to pay back a big bond that expires around May, and also Spain will need another 30 billion in July. And don't forget that we also have the reset of the mortgages in the US in June. In my humble opinion, things don't look that good for the European economy. So far it looks like deflation is the biggest danger, and we could have a situation like Japan in the past. There is liquidity, but there are no new investments, no growth. Prices might get down, but liabilities remain the same. We have very difficult times ahead of us, and the best way I can think of that a private trader or investor can exploit this situation is through the use of options. You can control your profit, you can control your risk, and basically you can transform your position in any way you wish. I also want to warn there is going to be lots of volatility in the next couple of years. The rescue plan that was recently released only provides liquidity with better terms for the next 2 years. Fundamental problems in Greece still remain. We don't know how we are going to solve this. I think the markets mostly affected would be gold, oil, the government bonds, and European currencies. And remember that there are already talks of the British pound devaluation. Thank you very much for listening to me. Now I pass on the microphone to John Netto. I think he's a great trader, and I think you will be very much benefited from what he has to say. I will be here for questions after the webinar. Thank you. Can I ask one quick question? Did Greece join the EU under false pretenses? From Susan R.
I think, Fotis, this is a good time to actually, because it's fresh in everyone's mind, and people do have some basic fundamental questions. Yes. Not a bad time to go ahead and do a little.
Yes, I want to tell to Susan, yes, this is exactly what happened. What the Greek government didn't meet any of the requirements of the Maastricht Treaty. So, but they wanted to be part of the common currency, and also Europe wanted them to be part of it. So what did they do? They go to Goldman Sachs and they make a swap deal with the Japanese yen. They receive 1 billion euro. So they look that their books, the books are okay, and this money don't show in the books. So what happens? We have a time in future where all of this come out, and we have the crisis. But yeah, you are right. It was false pretenses. Yes.
We have Dr. Frank asked a number of questions in terms of actual options protocol, which doesn't necessarily apply to the Greek crisis. I'm just scrolling through.
Okay.
That's Danny asking about the sound. Any questions, just real quick, over what Fotis just covered in terms of some of the fundamental backdrop or that he's just discussed? Okay. Obviously, any questions that come to mind, we'll go ahead and hit Fotis up a little bit later in the presentation. I'll go ahead and hop in here now. Just kind of like to do with every presentation, just give a very short 1-minute kind of background of just options for those that may be your first time or new to the options space. When I talk about background, I'm talking about calls, puts, strike price, implied volatility, expiration month, when I might refer to intrinsic value, and you'll hear me, interchange the four Greeks. But when I talk about a call, again, there's a lot of great resources out there. Steve Meisinger puts on a number of really solid classes covering all of these things which I'm going to talk about here. But by call, we mean it gives me the right, but not the obligation to buy an underlying vehicle at a certain price by a certain date. The converse rests with a put. Gives me the right but not the obligation. The key point being is not the obligation to sell a certain vehicle by a certain date. So if I'm long a call, I'm bullish. If I'm long a put, I'm bearish. If I'm short a call, I'm bearish. If I'm short a put, I'm bullish. Work the logic out from there. And hence, if you are working a put spread or a call spread, the short leg of a put spread is bullish. The long leg of a put spread is bearish, et cetera, et cetera. When I talk about a strike price, that's the strike price is the agreed upon price that you have. Sorry about that. And a strike price on the call. The lower the strike price on the call, the more valuable the call is. The higher the strike price on a put, the more valuable the put is. Implied volatility. This is something that will be coming out. Actually, I'm extremely ISE to make it so that we could put on a number of these educational events. The next event actually will be how to survive a volatility. And so when we talk about implied volatility, it's a little bit different than realized volatility in the sense that it can be a lot different at times. But implied volatility, let's say on the S&P 500 right now, the VIX, if you will, rests at around 17, okay? But the realized volatility of how it's actually trading has been closer to 8 or 9 in the last couple of days, meaning the realized volatility rests that the market has about a standard deviation of 9%, whereas the implied volatility suggests that it has an annual standard deviation of about 17%. So you'll see people out there make bets on volatility versus what the market is pricing on volatility, juxtaposed to how it's actually trading or how you foresee it trading. Expiration month, this for an option is much like an insurance policy in the sense that the further out the expiration month goes, the greater time value an option would have. An intrinsic value, you may hear me refer to throughout the course of this presentation, refers to if the option will expire today, what would its value be? And then lastly, talk about the four Greeks: your delta, gamma, theta, and vega. By delta meaning you have an at-the-money call. How much if the stock or underlying or the EUI goes up 1 full point, how much will that option rally by? And the delta of that gives you a static viewpoint of how that plays. The gamma really talks about some of the other components. Gamma talks about how much that delta will react or how that delta responds based on an underlying move of 1%. Theta, we talked about the expiration month and the time value being a component. Well, how much will an option be worth now versus a week of expiration, with all the other Greeks being equal, all other things being equal. Vega, that's your volatility risk, but if implied vol were to drop by 1% what is your Vega exposure? What is your volatility exposure? And you'll see a lot of option geniuses, a lot smarter than I, neutralize their Vega risk is a common thing you'll hear along that line. Yes? Okay. There's Fotis just to the back. There's some questions building up here, asking about some of the geopolitical events taking place in Greece. Go ahead and hit those when I wrap up my presentation. Okay. When I finish up there. Okay. All right. Realized volatility of major currency pairs, and this is everything I'm showing you here is going to set up into the strategy based on what Fotis talked about, and based on how I think you guys want to play this market in the next 3 to 6 months, and actually how I'm playing this market for the next 3 to 6 months. So I guess the proof's always in the pudding, right? The first thing I think you want to start off everything with is looking at the underlying spot. Now, again, to have, as Steve talked about, access to these ISD FX options, you just need to have an equity account. But I still think it's important, it's essential that you have access to look at the underlying spot currency prices. In the case here, using my CQ, I can see that looking at what the price action the euro has been. This was as of Friday's close. There was obviously a nice uptick based on the news of the bailout before retreating back a little bit. We have a current price now of 136.13. This shows 134.99, so about 112 pips or so from that close over the last 2 days.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.